Welcome to Be Open to Wealth. These are the 10 rules the wealthy never break and why you should follow them. I say that not as a platitude, but as a blueprint. I've seen it work over and over with clients, students, my own finances. Wealth isn't magic. It's a series of repeatable behaviors that compound over years. In the next 8 minutes, you'll get a practical, no-fluff playbook for lasting wealth. I'm going to be blunt, practical, specific, because vague advice is expensive. We'll run top to bottom through each rule with one actionable takeaway. That roadmap will keep this simple. Every rule includes a short explanation, a concrete example, one thing you can do today to make real progress. Rule 1 is obvious, but brutally hard for a lot of people. Spend less than you earn. Plain and simple, that margin between income and expenses, savings, investments, optionality. I track every dollar. Subscriptions, coffee, groceries for 90 days to see real habits. Once you know the outflows, set a sustainable margin. Aim to spend 70 to 85% of your take-home pay, leaving 15 to 30% free to save and invest. For a concrete example, bringing home $5,000 a month, target $4,250 in expenses, route $750 to savings and investments automatically. The key isn't deprivation forever, it's building that habit and buffer so opportunities and downturns don't derail you. If you can't hit 15 to 30% right away, start smaller and increase by 1 to 2% each month until you get there. Pay yourself first is not negotiable. Before you ever see discretionary money, automate transfers to savings and investment accounts. Treat your own future as a mandatory bill. Set up automatic transfers the day you get paid so you never have to rely on willpower. I personally move a percentage into brokerage accounts and retirement accounts the second paychecks clear. Treating savings as a fixed expense removes temptation. Use multiple buckets, one for long-term investments, one for short-term goals, one for retirement. Automation makes that painless. If your employer offers direct deposit splits, use them. Otherwise, use your bank's automatic transfer features. The actionable takeaway: set up an automatic transfer equal to at least 10% of your paycheck this week and label it "Pay Myself First." An emergency fund is your financial shock absorber. No drama, no forced asset sales. Aim for 3 to 12 months of living expenses, job stability, family size, income, volatility. If you have a stable job and dual income, 3 to 6 months might suffice. Freelancers and business owners should lean toward 9 to 12. The purpose is simple. Avoid selling investments at a loss, medical bills, car repairs, unemployment. Put this money in something liquid and safe. A high-yield savings account, short-term money market, not the stock market. Start by calculating your monthly burn rate. Automate a transfer that reaches that target in 6 to 12 months. If something unexpected happens, you'll be grateful you didn't have to liquidate long-term positions. Chapter 4. Diversification is the difference between investing and gambling. Millionaires build broad market exposure. Index funds, ETFs, diversified portfolios, instead of picking single stocks hoping for moonshots. A single stock can double or go to zero. A broad S&P 500 index exposure smooths that risk and captures market growth. My recommended allocation for most people is a heavy allocation to total market S&P 500 index funds, supplemented by international bond exposure based on age and risk tolerance. If you want a concrete split, 70% total stock market ETF, 20% international, 10% bonds for a growth tilt. Adjust based on your horizon. The rule: don't let a newsletter or hype lead you to bet the house on one idea. Diversify first, speculate with spare change. Chapter 5. Time is the secret weapon of compounding. Short-term trading is a tax on your returns and your sanity. Investing for the long term means buying diversified assets, holding through volatility, letting compounding work. For a simple timeline example, invest $10,000 at age 25 at an 8% return. It becomes roughly $46,600 in 20 years and $215,000 in 40 years. Time multiplies results. Trying to time the market costs you, because the best days often follow the worst days. My rule of thumb is to have a plan and a target allocation and rebalance annually, not trade daily. Focus on consistency. Monthly contributions and annual check-ins beat frantic trading every time. Chapter 6. Taxes are the single biggest drag on returns. Do everything legal and smart to reduce them. Use tax-advantaged accounts like 401ks, IRAs, Roth IRAs, HSAs, and 52ns where appropriate. Each account has a role: retirement, tax-free growth, or education. One practical strategy is tax loss harvesting in taxable accounts, or using tax-efficient funds to minimize annual distributions. For example, if you have a taxable brokerage account holding underperforming positions, you can sell losses to offset gains and rebalance into similar ETFs to maintain exposure. Work with a tax-aware advisor if your situation is complex, but start with the basics. Max out employer match, or pre-tax strategically, and prefer tax-efficient ETFs in taxable accounts for long-term holdings. Chapter 7. Leverage is a tool. It can accelerate wealth or accelerate ruin. Productive debt, mortgages, business loans, well-structured investment loans. They buy assets that appreciate or produce cash flow. Consumer debt, high-interest credit cards, personal loans is destructive. Eliminate it. Rule of thumb: keep non-mortgage consumer debt at zero. Keep total debt service under 30 to 40% of cash flow for individuals. For real estate investors, guideline: loan-to-value under 70 to 75%. For conservative portfolios, higher if you have experience, higher with a margin of safety. Always stress test scenarios: if rates rise 2%, if rents fall 10%, can you still service debt without selling core assets? Chapter 8. Protecting assets is as important as building them. Insurance covers unexpected losses: homeowners, auto, health, umbrella liability policies. These policies shield you from catastrophic events. Liability protection prevents a single lawsuit from wrecking years of work. A properly sized umbrella policy is cheap relative to the risk. Basic estate planning: wills, beneficiary designations. These steps ensure your assets go where you want and help your family avoid unnecessary legal battles. My one-sentence summary: insure appropriately, maintain liability protection, and have basic estate documents in place. These are not glamorous, but they stop one bad event from tossing you back to square one. Chapter 9. Wealthy people read learn. Surround themselves with better people. It's how opportunities compound. Allocate time to read investment books, industry reports, credible newsletters. Make advisors part of your team. Networking isn't about schmoozing, it's deliberate relationship building. Help others show up. Exchange value. Attend one relevant event each month or a meetup each month. Follow up with 3 people afterward. Over time, those relationships lead to deal flow partnerships, faster learning than solitary study. Treat learning and networking as recurring line items in your calendar, not optional extras. Chapter 10. Building wealth isn't just for you. Planning how it moves to the next generation is essential. Start with a will and beneficiary designations so assets transfer cleanly and avoid probate where possible. Consider trusts to control timing taxes and protection for heirs. They can prevent disputes and preserve wealth across generations. Succession planning also means preparing the people who will inherit wealth. Teach financial literacy, set expectations, create governance if multiple heirs are involved. The practical takeaway: create or update a basic estate plan this year. Will beneficiaries a trust if your situation warrants it, and have one conversation with the key people who will be part of your succession plan. Outro. Follow these 10 rules and you'll stack the odds in your favor. We covered the fundamentals: margins, automation, emergency runway, diversification, compounding. Thank you for watching.